Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. Well, we've had a very interesting week in the markets with geopolitical tensions rising between the US and North Korea, and as investors were observing the news and the dialogue going back and forth between Washington and Kim Jong-un, we had a sell-off in the market where a lot of these investors and even fund managers felt that it would be best to move to the sidelines instead of taking a chance and risking their portfolios on the downside. So we're looking at a 1-year daily candle chart of the S&P 500 index. That's the SPDRs, ticker symbol SPY. And as I do each and every week, I've left my lines in place so that you can see how the forecasts have panned out. And on this day, that little red candle right there, that is the day that I put out the last report, last Friday. And these lines are what I drew as my forecast lines. I said that at the beginning of the week, this week, we would see a slight rally and then a pullback from resistance, which is that horizontal line that I drew. Now, if you're brand new to the market, guys, you may not know how accurate our forecasts are, but we're currently ranked #1 in the world for projecting price action in the markets, and we make this very public. So if you can, go to our website, look for last week's market report, and you could follow along to see that when I drew these lines, there was no price action. I was basically drawing on a whiteboard, and that's exactly how the market played out. On Monday, we rallied from the close on Friday. On Tuesday, we went right up to that resistance point and came right back down in the same day, closing lower. On Wednesday, we then moved down below the 20-period moving average and hit my target. The end of that line is my target forecast, and then once we hit my target, we dropped even further, and then now we closed today, Friday the 11th, with what's called a spinning top. Now, as I erase these lines and draw the new ones for you for next week, you'll be able to follow along to see again how accurate these forecasts are. And next week, I do believe that the SPDRs are going to move from these lows right here. I think we're going to start moving up just a little bit to test this 20-period moving average, which is now going to be a resistance point. So I'm going to draw my new resistance with a horizontal line. And the signals that I'm seeing, which drives me to this forecast, is that we have a big down day on Thursday on super high volume. Again, this is the news out of Washington that an attack could be imminent. And then today, Friday, we have what's called a harami, this 2-day pattern, a long red candle with a small body candle within the opening and the close, or within the range of that day. That's called a harami. That's fairly bullish. The other thing that supports that bullish sign is that the downward leg here is now showing a lower volume. So the lower volume, or the drop in volume, tells us that the sellers are losing some of that momentum. So again, next week I would expect a rally in the S&P with a test up here at resistance. Remember, the end of this line is my target right there. So that is at 245.88. And you'll see most likely that that's what will happen for next week. Now, if I look at the diamonds and explain to you the story of how we came to our forecast last week, I did say that we would move lower on the diamonds. And again, here is Friday's report. Let me zoom in a little bit more so you can see that. Friday, the report went out right here on that red candle. And Monday, Tuesday, we started to sell off. Wednesday, Thursday, Friday. Now, we did not quite get to my target, but we did move lower as I forecasted. And the diamonds, I think, are going to find some support, just like the S&P for next week, where we could see just a little bit lower as a test or a bounce off of that 20-period moving average, and then move up towards the end of next week. Again, this lower volume on the diamonds at the end of a downward leg is telling us that the sellers are losing some momentum. I'm going to give you a video link to go to learn more about how price and volume work and react to one another. They are, in my opinion, the most important things you can look at is the price-volume divergences, because price will give us the direction of the move, but volume measures the strength of the move, and that's what we teach each and every week at the Market Guys. So that's my forecast for the diamonds. If we look at a more broad-based index in the Russell 2000, you'll see that early on I said that we would move up in the week. Again, this is right here. This was the Friday report, went out right on that green candle, and I said because of that green candle, the market would rally, with my target being right there at 1427.96. The high from Tuesday came to 1426.29, so we were within pennies of hitting that target. I'm going to mark that as a win. And now as I remove our lines from last week's report, I'm going to draw this all over for you again. The Russell 2000 is at a level of support. Right around these areas right here is a level of support. And you see this small-bodied candle is known as a spinning top, found at the end of a downward leg. That tends to be bullish when you see that at support. It's number one. Number two, there is a wide divergence from this 20-period moving average. So in other words, the price divergence from that moving average is wide, and we call that the rubber band effect. Again, wait to the end of this video and I'll give you some resources to learn more about the rubber band effect. When a stock moves this far away from a moving average, whether it be moving down below or stretching far above, the price has a tendency to gravitate back towards that moving average. So I believe that next week we're going to see a rally in the Russell 2000. I'm not talking about a major rally where you should sell everything else and buy stocks. I'm just telling you we could see a bounce. Long term, I'm still very bearish on the general markets, but we do see these very short-term opportunities to get in and get out quickly to take our profits. So next week, I think the Russell 2000 will rally to my target price right there. Okay, now the last market I look at before going to the volatility index is the Qs. That's the NASDAQ market, also known as the power shares. And I said that we would move up early in the week. There's my target. There's the high from Tuesday. And guess what? Again, within pennies, resistance held right there. Market pulled back from resistance. And there we are, just like the rest of the markets, where we see a drop in volume, a stretch below that moving average. So what I'm going to do is, again, erase all lines right here. And I'm going to redraw the forecast lines for next week. This little gap down here is going to act as support right there. There is a chance that we can go down a little bit further to test that support, but I don't think we're going to go all the way down. I think we're going to rally because the general markets are already oversold for the short term, and I think that the Qs are also going to test that 20-period moving average as resistance. Now, finally, if you go to the Market Guys website, you'll see that there's a link at the very top over here where it says videos. If you click on that, it'll bring you to a library of videos that we call market shots. You can scroll down and you could see the video for the rubber band effect, which is what I mentioned. And you also want to look at the price and how the role reversal and prices react with one another. And if you follow the moving averages right here and learn how to measure volume, you will be able to hone your skills to a point where your confidence will spike. And as a risk management tool, charts are the #1 tool. Again, it's not just about forecasting the markets. It's about managing risk in the market. And as the tensions build on that geopolitical stage that I talked about, it's very important that you learn how to manage risk. One of the other videos that we have in the library is the 1% rule for managing risk. Please go over that. It's probably the most important video we have in the library. Again, those videos are free. They're for you to take and look at your own schedule, and you can go ahead and get an education 6 to 7 minutes at a time. They're very short videos. So that's our market report. Be sure to share this on Twitter, Facebook, and all the other social networks. The more people that we have following the charts, believe it or not, the more accurate the charts become. Because when the masses start to follow the signals in sync, that's just like a major analyst who has a following of millions of people putting out a buy signal or a sell signal. The market will be moved as investors react to these signals, and it just helps us get a leg up or an advantage over the professional traders so that the average investor like you and I can go out there and at least have an advantage to make some money. So that's it from the market, guys. Have a great weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.